Investment. You have just bought a house in the Bay Area for $1 million. Real estate forecast predicts that houses in your fire-prone neighborhood either gain 30% or lose 25% in value each year. You plan to sell the house after 2 years. List all possible values of the house after 2 years, together with the probability for each value. Find the probability that the house is worth more than $1 million after 2 years. Compute the expected value of such a house after 2 years. Discuss whether buying houses in the neighborhood is a good investment. We will list 4 scenarios here. There are 2 stages. The first stage is the first year, whether we will gain 30% or lose 25%. And then after that, the second stage of the second year, we either gain or lose for each of the outcomes for the previous years. And so, there are 4 possibilities here. Gains the first year, gain the second year. Gain the first year, but lose the second year. Lost the first year, gain the second year, or lost the first year, lost the second year. There are therefore 4 possible values. We will also list their corresponding probability, but first we will summarize this in a table. This is the first year, first stage, and second year, second stage. The first year, we gain 30%. The second year, we gain 30%. That is the first scenario. The second scenario is that we gain 30% the first year, but we lose 25% the second year. So this is a loss. The third scenario is when we lose 25% the first year and gain 30% the second year. And for the last scenario, 25% lost the first year, 25% lost the second year. We then list the value of the house after 2 years. So this is the values after 2 years, not just 1 year, but 2 years. We start with 1 million. We will denote simply $1 for 1 million in this case. A 30% increase has a factor of 1.3. This is because 0.3 represented 30%, but when we take 30% times 1 million, we only get the amount that was increased. We still need to add this to 1 million to get 1.30. And so the factor we need to multiply is again 1.3 for 30% increase. And that is the value of the house after the first year. And then we take this and we multiply 1.3 to get the values after 2 years. And so this is $1.69 million. This has a probability of 1/4 because this is 1 out of the 4 scenarios that we list earlier. We might think of this as a sample space: gain, gain, gained, lost, lost, gained, and lost, lost. And so the first scenario, gain, gain, it is 1 out of 4 possible outcomes. Similarly, we take 1 million times 1.30 and then we would multiply. Be careful here. If we use 1.30 for 30% gain, then a loss of 25%, we would multiply it by a factor 0.75. Multiplied a number that is less than 1 would decrease the value. Multiplied a factor more than 1 would increase the value. And so in this case, we will get 0.75 $0.975 million, and this has a probability of 1/4. Similarly, we take $1 times 0.75, that is a loss, and then times 1.30, this is a gain, and this will give us $0.975 million. This has a probability of 1/4. And then lastly, we take $1 times 0.75 for 25% loss, and then we multiplied another 0.75 for the 25% loss the second year. This will give us 0.5625 millions, and this has a probability of 1/4. And so that answers part A. We list the possible values. There are 4 cases after 2 years, together with the probability. Part B. Find the probability that the house is worth more than $1 million after 2 years. And that is only 1/4. There is only one scenario out of 4 where the house is worth more than $1 million after 2 years. Compute the expected value of such a house after 2 years. To compute the expected value, we take the values of the house and then we multiply the probability and we add them. And so in this case, we will take 1.69 times 1/4 plus 0.975 times 1/4 plus 0.975 times 1/4 plus 0.5625 times 1/4. This will give us 1.050625 million, or this is $1,050,625. So the expected value after 2 years is $1,050,625. Part D. Discuss whether buying houses in that neighborhood is a good investment. From this table, we see that there is 1/4 chance that we will make money, and there are 3/4 chance that we would lose money, because 3 out of 4 times the value of the house after 2 years is less than 1 million. So 0.75 chance, 3/4 probability, the house is worth less than 1 million after 2 years. And so we would say that this is not a good investment, because there's only a 1/4 chance that we would make money. There are 3/4 chance that we would lose money. But did that contradict with part C? We see that the expected value is 1,050,625. Clearly, this is more than 1 million. Well, not quite. The expected value only refers to the long run, or if we were to buy 100 of these houses, then after we compute all the gain and loss, we expect to make about 50,625 on each house, but only if we buy the large number of houses, or perhaps if we have investors, 100 investors, each put in $1 million. After 2 years, each of them would expect to earn 50,625 only for their 1 million investment. But again, only with a large number of investment, and that is what the expected value is saying.